Capital markets. Internal versus external sources of funds. Internally generated funds include retained earnings and cash flow added back from depreciation. Composition of internal funds is a function of corporate profitability, dividends paid, resultant retained earnings, and depreciation tax shield firms avail. The supply of capital funds. Household sector is a major supplier of funds. Consumers spend money. That's where a lot of the funds come from. Indirect investments. Household savings generated by wages and dividends. They're funneled into financial intermediaries that in turn make investment in the capital markets. Purchase mutual fund shares, invest in life insurance, or participate in private pension plans. And these different plans in turn invest in these companies. Diverse financial institutions channel funds into commercial banks, mutual savings banks, and credit unions. So many financial institutions also channel these funds, which are another source of supply for the capital funds. Here are different chart of flow of funds into the economy. So you can see there are three sectors that consist of households, which is the major supplier of funds for investment, businesses, which is the net demander of funds. Businesses need the funds in order to operate, and then the government, also a net demander of funds. As you can see, business is the biggest portion of needing the net demander of funds on here. Supplier of funds to credit markets. This is in September of 2008. So you can see this showing the supplier of funds chart here. The role of the security markets. The capital markets are divided into many functional subsets. Each specific market serves as a certain type of security. Secondary trading. The security trades in appropriate markets among all kinds of investors, provides liquidity to investors, and keeps the price competitive among alternative security investments. Many of you, if you buy a security through, say, a different online broker or through a local broker that you have, that would primarily be considered secondary trading unless you are getting involved with an initial public offering purchase of a new stock. Security markets provide liquidity by enabling corporations to raise funds by selling new issues of securities and allowing investors to sell them with relative ease and speed. Corporations and government units would not be able to raise large amounts of capital for economic growth without markets. It would be almost impossible to do so. The organization of the security markets. Security market structuring has changed because of technological advances, which include the rise of electronic communication networks, mergers or alliances between exchanges, transformation of membership-owned organizations to public companies, and acquisition of leading ECNs by the traditional exchanges. Traditional organized exchanges, either national or regional, are both structured in similar fashion. Exchanges have had a central trading location to buy and sell securities. Each stock trades at a physical location, a trading post, on exchange's trading floor. Brokers are registered members of each exchange. The New York Stock Exchange is the largest of all traditional exchanges. Regional exchanges began by trading securities of local firms. Trading on these exchanges are primarily done in nationally known companies. Trading in same companies common between New York Stock Exchange and regionals, like the Chicago Stock Exchange. More than 90% of companies trade on the Chicago Stock Exchange are also listed on the New York Stock Exchange, referred to as dual trading. Listing requirements for different exchanges. A firm's securities can be traded on an exchange if company meets listing requirements and has been approved by Board of Governors of that exchange. All exchanges have minimum requirements that must be met before trading occurs in companies' common stock. They're most restrictive at New York Stock Exchange, and they're least restrictive at, say, the NASDAQ. End of part 2.